The question is how much pain Trump himself is willing to tolerate. I think the answer is he's willing to tolerate a lot more pain on the stock market, as you just heard him say.
Recent stock market volatility. Eamon Javers joins us now with more. Hey, Eamon.
Yeah, good morning, Joe. In an interview with Fox News yesterday, President Trump addressed last week's stock market turmoil caused by confusion around his tariff agenda. In one exchange, the president suggested that calls by the business community for clarity on that policy are just a talking point for the big globalists. Here's what he said.
I think that they say that. You know, it sounds good to say. But for years, the globalists, the big globalists, have been ripping off the United States.
And asked if he's okay with the stock market going down, the president dismissed the idea of short-term focusing on the stock market.
What I have to do is build a strong country. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We have a quarter. We go by quarters.
That's true.
And you can't go by that.
Now, that's a striking departure in approach from the first Trump administration when cabinet members suggested that the stock market was a good barometer for how well the administration was performing. But this is a much more populist Trump administration than in the first term, and you see that reflected by the president now dismissing stock market losses as pain for globalists, not his voter base. We'll see if Trump continues that approach later today when he's expected to meet with top technology executives at the White House. We expect the discussion there will include the president's tariff agenda, also his call to repeal the Bipartisan CHIPS Act. And guys, Andrew, I was thinking about this morning. You and I were at a dinner in New York on Thursday night where the discussion was largely around this. Just how populist is this Trump administration and how much do these stock market losses move the needle inside this White House? And I think it's a different calculation this time than it was last time around.
So it may be different in this particular moment. The question is, if this were to persist for several months or longer, how you think that changes the dynamic, which is to say, if the stock market continues to fall as you were to walk into midterms, for example, does that change what they want to do, or do you think that they're all in?
So I think there's an intellectual group who are all in, of populist, conservative economics folks who look at this and say what we need to do is entirely restructure the U.S. economy. And the focus for too many years, too many decades, has been on lowering prices, not on families and communities. And that's really the central unit of the economy, should be the family, not prices. And you heard Scott Bessent, the Treasury Secretary, say this last week, you know, that the ideal of the American dream is not about access to low prices, it's about other things. That's that sort of worldview. The question is how much pain Trump himself is willing to tolerate. I think the answer is he's willing to tolerate a lot more pain on the stock market, as you just heard him say, this time around than he was last time. But I don't think that's indefinite, right? I think there's some threshold larger than it was last time around at which the president might respond to stock market losses by changing course politically. I think we've got a ways to go, though, before that happens.
Yeah, it's not just how deep, but also how long. You know,
and he can point to interest rates too, Eamon, which don't always, you know, the bonds themselves don't always sync up with equities, and you could actually say, you know, equities coming down, and as a result, bond prices go up with the safety, and then he would immediately talk about mortgage rates and consumer loans and all the benefits that come from that. So you can kind of have, you can pick something else to brag about if the stock market is not cooperating.
Yeah. And it's largely about jobs, right? I mean, so one conservative economist looked at this and said to me, imagine rolling back the clock to 1990 and telling somebody in a small town in the American heartland, look, in the future, your TV will cost 10 times less, but your children are going to have to move out of your town because there won't be any work for them. Would you take that deal? And he said that, you know, 90% of Americans would not take that deal, even if it meant cheaper TVs because of the devastation of their community.
Can you get the jobs back, especially when you're talking about automation of factories at this point? I mean, and how long it takes to put some of those
that's
things
the huge gamble
How big
that
a
this administration is making.
Like a 75-incher, or I mean, what are we talking
debating
about?
whether you'd take the deal?
No, I would not. I would not.
I mean, how many kids do you have, right? I mean, you know, it's that calculation too.
Exactly. Oh my God. These are really big questions when you think about it, Eamon. And here we are. We're in our little gilded cage. I mean, it really was hollowed out, the center of the country. And we do love those cheap prices, but it came at a... We'll see if prices really do rise, and it takes time to bring jobs back. And one might happen before the other, and we'll see what our actual resolve is.
Which I think you get back... I think that's what Trump... Oh, go ahead. Go ahead, Eamon.
Yeah, I was just going to say, I think that's what Trump was talking about in that soundbite, where he said what you have to do is build a strong country, not look at the stock market, right? He's signaling that that's his priority, is rebuilding that industrial heartland of the United States. Now, whether that's doable or not, as you guys point out, is a huge open question. Whether it's doable in any kind of time frame that lines up with political and economic reality is another question. But that's the goal that they're setting out to do here. It's a sweeping change, and it's not the sort of Chamber of Commerce, George W. Bush Republican Party that we've seen in past decades. This is a Republican Party that's very focused, again, on family and communities and workers, and that's a totally different approach.
Join us now to talk about what she's watching is technician Katie Stockton, founder and managing partner at Fairlead Strategies. Does that... Good morning. It's good to see you. Good morning. There's a number in what you told our people for the S&P that if that didn't hold by Friday, it would be significant. With that indication, and we don't know today if it's going to stay there, but that shows what it did on Friday. We should be showing the futures for what it says today on the S&P. So look at the futures. Is that below? Well, it doesn't have the total there. Or does that 61 points put us below the number? What was your number?
It does, yeah. And in fact, we actually closed below my number, which was 57.83 last Friday. The reason we care about this week's trading is that that would confirm the breakdown, assuming we stay down below that level this week. The short-term indicators are still primed for a rebound, so it's possible we avoid that confirmation. But I think the fact of the matter is that we have very weak momentum. It's evident behind the market. And if you take a step back and look at the major indices, they look a little bit like a double top formation, kind of the shape of an M on the chart. And that's not a good setup.
You said that the near term, there's counter trend signals that could indicate a bounce that would be short-lived.
That's right. So several days, not several weeks. So our messaging has been to wait to get hedged or to reduce exposure. There's a lot of stocks that have broken support levels, as you can imagine, with this downdraft. And because these look like the double top formations, it probably will affect Q2 as well as what we've already seen.
So 60, 70% of the time in any given year, you have a 10% correction, I think, in the S&P.
Right, and we're not quite there yet.
Is this going to be it?
I think we'll probably see a little bit lower than that based on where secondary support is.
Worse than 10%.
Worse than 10%. We're already several percent off the highs, right? So the next support for me is around 53, 65 to 53.
50 what?
53. We have a 53 handle on that.
That's another...
and so it's about 6% below.
And it's another.
And it doesn't mean it's
8 or 9% from here, isn't it?
It's not a magnet necessarily. Support doesn't act that way, but it does frame potential downside risk. What we'd like to see is an oversold reading in our weekly gauges, and we don't have that yet. That could happen and get us a sort of a nice relief rally in between here and there, but it does frame downside risk.
Would you think that the NASDAQ would be in bear market territory if the S&P? I can't imagine it wouldn't be.
It could be. So you're seeing the 20% plus downdraft. It's certainly possible. It's higher beta, and the technology sector has lost its leadership stronghold, and also the mega caps, and that's a big difference between this year and the last 2 years. We just don't have that mega cap leadership.
And you wrote this stuff before the clocks were turned. I mean, you're not just in a bad mood. Like, you're not just tired. And Andrew is exhausted.
Well, yeah, I am a little tired.
So this has nothing to do with Monday or daylight savings.
No, it's just not a bad mood. And listen, I mean, this is actually normal price action for the markets. We've just gotten so accustomed to a market that's barely interrupted on the downside for 2 years. So it feels really unsettling. There's plenty of reasons you could assign for the downdraft, but the fact of the matter, it's a very healthy longer-term development ultimately to get this kind of corrective action. The secular bull trend is very much intact. And we just think this is going to be more of a digestion year, more sideways than it is lower. Yeah, indigenous, good way to put it. So we think that it will ultimately prove healthy.
Kate, I know you don't look at fundamentals for the most part. You're looking at these technical measures. But when you take what President Trump is now saying about the idea that you're going to live through some pain as we go through a transition, he thinks it's temporary. What do you see just in terms of if you could try and put that into what you see from the technical?
Well, right. It would actually be very much in following with what we're thinking, where we have this initial downdraft, and it feels very unsettling. It's what we already have, in fact, and now I think we're going to start to see the international equity markets participate on the downside to some degree. We've had such huge gains outside of the U.S., right? So it's been very U.S.-specific.
You think oil is going to bounce?
I do, and that's a little bit of a contrarian.
Yeah, and that's been sort of a confirmation of a slowing economy, I think, so far. So does it bounce to 75 or to what?
I think into the low 70s per barrel for WTI is very viable based on our indicators. There we have a long-term neutral triangle formation. The triangles represent sort of a lessening in the volatility, but indeed it has been quite volatile short-term.
The confidence you have about charts, is it the same across all asset classes, or do you say to yourself, the charts seem to hold up better on equities, oil is more complicated, Bitcoin is something else, or are they all just the same?
Well, I would actually argue that anything that has like the deepest, most global liquidity will lend itself best to the charts, right? Or the indicators and the levels will be more refined, perhaps. But it is applicable across asset classes. The only place it really doesn't add value, perhaps, would be maybe a small cap biotech stock that has a binary situation. That's where, or where there's no liquidity. But for like, especially global FX and commodities,
and really on everything.
This is all very negative.
It is. You know what's
well, if we can look beyond,
this is a really
5:20 in the morning.
This is a really tough pill to swallow right now. I mean, I knew things were bad, but now it's going to be worse.
Try to think past this consolidation to the secular bull trend and realize that this is
when's that part coming?
Necessary. I think probably closer to Q4.
I'm not going to do a full boomer report, but once again, Jeopardy, 12th century mathematicient, Fibonacci.
So
we use Fibonacci.
These are key levels. I honestly wish.
He was born in 11th, so that's.
I wish I knew why it mattered, but frankly, I do think these levels matter a whole lot because I've been watching them forever. So that range of support that I gave you is partly based on the Fibonacci retracement levels. It's a 38.2% retracement of the last bull cycle move.